But first, worriers gonna worry. At least that was something that was said in a new note that Myles, you wrote about in the morning brief. I think haters gonna hate is a little more catchy, but worriers gonna worry in this context is appropriate. And you basically talk about the economic data that we've gotten recently that has pushed a lot of economists to raise their forecasts. Yesterday, we talked to Mohamed El-Arian, and he says the Fed itself is going to be pushed to raise its GDP forecast even further. And yet there are still, of course, doubters out there as to the robustness of the recovery that we're going to see. So when you look at the sort of two sides here and you look at through the eyes of that note that you wrote about, what sort of was your conclusion?
Look, I think when we started the morning brief, it was like, how can we just tell people that stocks usually go up every day without just telling people that stocks usually go up every day, right? This was before we had the TikTok meme format. So when I saw this note come over from Bank of America, it was published just before the Fed meeting took place on Wednesday afternoon, but none of the themes really changed. The point is that, like all bull markets, this current one, which began almost exactly 1 year ago, is riding a wall of worry. That is one of the foundational cliches within financial markets. So yes, of course, we cannot say that exactly every day. But this note basically reminds investors at a time like this, coming off a day when the NASDAQ falls almost 3%, that if there is liquidity, if earnings growth continues, basically if the business cycle is still improving, and if more stocks and more companies are doing better over time, then there are few reasons to say, well, this is the end of the line. Now, that doesn't mean, like we've seen in big cap tech stocks for the last 6 months now, that we can have periods where certain leaders become laggards, new sectors pick up the slack. I think bulls would say all those things are constructive ultimately within the market. But the major drivers of all bull runs, which we just had up there on the screen, remain very much in play right now. And the conclusion is that when the Fed starts to change, i.e. when the Fed says they are going to raise rates, or rather actually does raise rates, that is the time to start reformulating what your thesis is. I think in hindsight now, obviously stocks went up a lot, right? 16, 17, tax cuts, a lot of bullishness around what Trump was going to do for the economy, et cetera, et cetera. But the Fed in 2015 started saying the end of the cycle is beginning. Now, it took 3 years, basically, from December 15 to December 18 for the cycle to play out. But ultimately, stocks went down 20%. The Fed had to quickly backtrack, and that set the market up for what happened in 2019. And so let's circle back in the second half of next year, first half of 2023, when we start to really think about the Fed raising interest rates, and then we can start to talk about some end of cycle dynamics. But right now, the contention from Bank of America, none of those things are part of the present conversation. And so we are better served thinking about which stocks will go up rather than worrying that all the stocks are going to start going down.
Well, there is something that's happening right now that might cause some stocks to go down, although it is an anticipated change. And I just want to run through it here. It is breaking news. The Federal Reserve had relaxed capital requirements for banks. And now it's saying it is not going to extend that relaxation. And again, this is a change that was expected, but it's also expected to have ripple effects throughout the Treasury market. And you can see the effects that it's having there. The chart that you're seeing on your screen is the price of Treasuries. So this means that the yield would be going higher. We were just looking at the yield a few moments ago as it was going down this morning. So something to keep in mind here is that this could then have a ripple effect and trigger some selling in the Treasury market as a result of this change to bank rules. But again, it was expected, so unclear what now the effect is going to be, but we'll keep an eye on the banks here as we continue to watch the effect of that. You see there the XLF, the financials ETF, is down a little bit in pre-market trading. Again, this was something that was expected, but given the heightened sensitivity to the bond market right now, you got to factor this in when we are talking about what has been going on with stocks and the relationship between the two. And Myles as well, we should mention that this is something that takes effect on March 31st, where these rules get more stringent again for the banks.
And I think this is a great example, though, of putting back into context all the kinds of immediate cross currents that can happen within the context of a market that remains, up and to the right. And we see it here in the futures, just as this announcement crosses the tape. Now the Dow is lagging, as you mentioned. XLF now under a bit of pressure. Banks have been, major market leaders over the last several months. I mean, regional banks, I think they're up 40, 50% since the election, just huge outperformance there. And tech, as I just mentioned, has been lagging. And now we're seeing that rotation. And rotation within a market isn't necessarily a bad sign. And I think, again, another reminder for investors that all the details might change within a given market, but that does not mean that the overall market impulse, as it were, must fundamentally change as well.
Yeah, another reminder here too is, in that Bank of America note, Myles, it was a good read, and they call it their bullish cocktail of massive liquidity, the earnings cycle, and just a continuation of low rates. But out of all their points, for me as a fundamental person, I still watch fundamental analysis. I care about profits and margins. I care about sales. It's that earnings reacceleration that I understand why tech is selling off, but I don't think the market understands how fast earnings growth is going to be in the front half of this year. I hopped on. We'll talk about Nike and FedEx more soon, but Nike is suggesting their guidance 75% sales growth in the most recent quarter. That's huge. FedEx on the earnings call last night said, you know what? Because we're shipping so many vaccines, we're not going to bring our prices down in FedEx Express. Tells me they have pricing power, which could prop up their earnings even more, if not only for the first 6 months this year, for the rest of the year. So there's a lot of catalysts, I think, happening right now in corporate America. And I understand the market volatility. I understand 10-year goes up, tech stocks go down. At least that's been the trade now for the past few weeks. But the fundamentals suggest in many businesses, and of course tech, that perhaps stocks, to your point, Myles, should only be going up right now.
Oh, you and your fundamentals, Brian Sozzi, as if the market trades on those.
Still matter.